All right, so call to order February 7th regular meeting of the Retirement Plan Subcommittee. A short agenda today, typical agenda. Before we begin, I'll just open it up in case anybody has any non-agenda questions or comments. Otherwise, we can get right in to taking a look at the minutes. Does anybody have a question or comment about the minutes from last meeting?
No.
All right, hearing none, why don't we just approve those as submitted, and we can kick it off to Chris and Tyler for the quarterly update.
Well, good morning, folks. Good to see everyone in the new year. Trust everybody's well here. And can I get Melissa? You tell me how you want to proceed. I don't think I've got screen sharing access, but
I can give it to you. But if you want, I can pull it up.
Sure. If you could, that'd be fine. It's probably easier for Tyler and I to navigate through it instead of forcing you to do it.
All right, you should be able to.
Let's see here. Folks, see that okay?
Yeah.
Yes.
All right, let's put it, I'm just going to put it on full screen. So just shout out loud here if something arises, but we'll work our way through the deck here as we do each quarter and of course hit the highlights. I know on the surface things can look a little unwieldy just in terms of the volume, but I'll assure you we'll get you through the stuff we need to focus on. And before we dive into the detail, just overarching big pictures for the committee's perspective, I think, as you all know, right, the totality of 2022 was pretty difficult for capital markets for all the reasons we've discussed previously, centered really on the Fed rate hike campaign and the potential effects that might have on the broader economy, right? And that's what investors wrestled with the whole year. And it made certainly for some challenging times. There was a measure of relief in Q4, as we'll see in the numbers momentarily. And moreover, for what it's worth, in early January, year to date, things have been pretty constructive as well for both equities and fixed income. So who knows, maybe we're on the trail to more stable returns, but we do think in the interim here, until the Fed campaign is kind of fully settled and adjudicated, if you will, I guess, that things will probably continue to be a bit bumpy here. So we'll get you updated on all that stuff. We did run the the pension portfolios through the asset allocation framework, with the benefit of our new capital market assumptions, and we'll certainly spend a couple of minutes on that as well. And then obviously Tyler has his a standard sets of information. If you're inclined, I'm not going to spend a ton of time here, but our marketing folks will wrap Tyler and I on the knuckles if we don't at least highlight that there's lots of research on our website. If you're inclined, certainly visit fiducient.com, and we're putting new stuff and collateral out there all the time for folks. Our conference is next fall in Boston. You're certainly all invited. If you want to early bookmark it, we'll continue to remind you, but we think we've got a pretty nice agenda coming together at the Copley next fall. And then we do continue to hire. So you see on the bottom half of the page here, I think as we've talked about in the past, right, we try to hire in front of anticipated and thoughtful growth. And we do that, of course, because we don't want to in any way affect the level of services and attention that our existing clients get. So we do hire pretty ambitiously in front of that growth. And you see there a number of folks across the complex have been added in the last year or so.
Chris, can I interrupt real quickly? I mean, that is a robust list of new hirees, and are those all Connecticut employees, or are they spread out throughout the country? And I'm just curious because that's
great. Yeah, great.
At that analyst level, it's tough to attract talent.
Yep. No, it's certainly kudos to our HR folks and others. It's a mix. I'll tell you, as you know, you all remember, we've got essentially dual headquarters that operate out of Windsor and out of downtown Chicago. This is fairly equally split, Derek, between the two complexes. And then there's, we have satellites in Boston and Washington, and there's, folks who kind of fill into that, those efforts too, but a mix.
Yeah. Thank you. Curious.
Great, thank you. So let's just quickly, we'll re-level set here on the year before we look at some of the portfolio details. So I think I already mentioned, right, that the pressures on capital markets due to the Fed campaign. We won't talk about that or belabor it anymore. Maybe as a visual, though, just to give a little bit more context to the committee, look in the lower right-hand corner of the page. And you'll see what we've done. We've plotted in equity and fixed income return space the year that was 2022. And then you see, obviously, previous years back. I don't know, we did it for 30 some odd years. We probably have it listed here somewhere on the graphic, but several decades back. The takeaway, of course, is pretty awful year, right? And you see there both equities and fixed income downdrafting pretty significantly. So the idea, I think, that we collectively embrace, that balanced total return, diversified investment programs over time tend to be the right way to do things. We certainly think that continues to be the case. It was a nowhere's to hide kind of mentality last year, and regardless really of where you were invested, there were challenges from a return standpoint. It was even, I think, noteworthy to me. Look at 2008. Remember the financial crisis and notions that the global financial system was teetering on extinction, and you see, even in a year like that, right, the safety of bonds offered some relief against the equity downdraft. Last year obviously wasn't the case with what the Fed was doing. You had this double whammy effect, and a pretty awful year for capital markets. And again, certainly, hopefully, one that's in the rear view window and not to be revisited anytime soon. There is this, kind of final notion that we have, right, that the Fed effort is much farther along than not. And increasingly, if you look at a lot of the data, the notion of a soft landing maybe, and the Fed being able to thread that needle, and maybe the economy softens a touch but doesn't go into an outright recession, is one clearly an outcome that investors have been bracing the last several months. You see it in returns, as I mentioned, right, with pretty decent returns. So we'll see if that comes to pass or not. But we do think a lot of the pain is in the rear view mirror, but with bouts of volatility probably along the way here in the immediate future anyways, as everything settles out. Here's just quickly on the top half of the page, just to put a couple of particular numbers on the broad markets and what happened last year. You see the vertical bars, of course, are the full calendar year that ended in December. And as mentioned, right, look, three columns in from the left, the core bonds, investment grade, liquid, tradable fixed income, intermediate duration, down 13% last year, which is a number that market has obviously never seen. And unfortunately, that kind of malaise carried over across the totality of the investing spectrum. As you see there, with equities, global equities down, anywhere from mid-teens to upper teens, or wherever you may be, 20% down. So pretty difficult year. Interestingly, right, the fourth quarter, as I mentioned, a measure of relief there. You see in the encircled numbers actually positive returns across almost the entirety of the investing spectrum. And then kind of a concept I think that we've revisited a number of times in this setting, the notion of global equity and the case for international equity. And the dollar's weakened a bit over the last several months, and who would have guessed it, right? But international developed equities, by a long measure, the best performers in the fourth quarter last year, up over 17% and outpacing everything. And this committee, to their credit, right, has kind of stayed the course with international equities, and the portfolios have obviously been the beneficiary of that discipline. So that's big picture on markets. Let me pause there for a minute. I don't see everyone's face on the screen, although I can scroll. Anything big picture before we spend some time on the portfolio details that bears more comment or discussion? And of course, just jump in here if something arises. I don't see anything, so we'll press ahead here. I'm going to skip through a lot of this other detail that if the committee's inclined, and if you look at it and have questions, obviously along the way or after the fact, just track us down. From a governance standpoint, this quarter on the allocation side, particularly with the pension plans, this is the quarter, again, as I mentioned, where we dust off and revisit our expectations for markets on a go-forward basis. So we've run the portfolios through our optimization software. We'll show you the output in just a second here, with the benefit of those new assumptions, and really want to test the return potential of the program, right? And if we're kind of on track from an actuarial perspective, in terms of where we need to be. So we'll flesh that out here in the next minute or two. And I mentioned earlier, right, overarching themes for us. I talked a little bit about the notion that volatility is likely to remain a bit high here. So that's kind of a core theme for us as the new year takes hold. Inflation has rolled over, right? The prints that you're seeing are not as high as they were 6-8 months ago, but they're still elevated. And inflation is falling for sure, but still above the longstanding targets that the Fed has. So this is, again, this idea, right, that there's maybe some more work to do in the form of a couple more rate hikes to try to really quell things on the inflation front. And again, that's likely to keep volatility a touch elevated. And then finally, mentioned earlier as well, right, we had wholesale reductions in capital market valuations last year. Equities in particular, interestingly enough, when you look at valuation metrics, some of the multiples that folks look at, there was a contraction in those numbers, but earnings in a quirky way, right, hadn't caught up just yet. So maybe the next leg of some of this moderation or volatility is likely to come in the form of maybe softer corporate earnings. We've seen a little bit of that recently. But a lot of that work's been done, and that's rolled over, and that data is embedded into the system. So again, this idea that we're probably and hopefully further along in the correction, if you will, than not, is I guess the takeaway there. So those are big picture themes. Directionally here, you'll see on this page, just across the capital market spectrum, just on the margins here, kind of where we stand and some of the modeled outcomes that we'll see in your program momentarily, and kind of what what the system or models favor versus not, and a little bit in the upper right-hand corner, the way of a drawdown of the dynamic bond that we introduced into the program not too long ago, and we'll talk to that, and a little bit of uptake, as you see there, in core U.S. bonds. Not wholesale changes in global equities, but a little bit of a press from the system and the modeled outcomes to small and mid cap in the U.S. And so we'll see that in a minute. But otherwise, things kind of running along as they have. I think one of the interesting questions we get, just maybe to preview what I expect the committee might ask, and we'll see here, maybe bear with me. Let me jump ahead. You'll see it here, the whole year over year changes in the two columns in the right-hand part of this exhibit, most notably the uptake in fixed income return expectations. So we've gotten a lot of questions from committees, and it's a fair one. If we have much higher return expectations for fixed income, and can we dial back the risk in the program and not handicap the return potential of the program by virtue of these higher fixed income yields? And it's certainly a logical question, right? One of the things that makes us resist making wholesale changes, though, to allocations right now is that the downdraft was so uniform last year in capital markets, and if you accept the notion that volatility here is likely to continue to stay elevated, just doesn't seem like, from our standpoint, an opportune time to make wholesale changes to asset allocation in portfolio. So again, we'll talk to those particulars in just a minute, but our inclination here is to stay a little bit dialed into about where we are from an allocation standpoint and let markets settle down. And moreover, right, just think intuitively, right, we had 20% downs in equities last year, right? Doesn't feel like historically anyways, it's an opportune time to, redeploy out of equities on the heels of a big downdraft like that. And we've seen that in the fourth quarter and in January, where the equities have snapped back pretty nicely. So it's a long-winded kind of an introduction, but our sense is generally to kind of stay the course with allocations, but we'll show you the return potential and talk about that in just a second here. But again, upper right-hand corner of the page, most notably, you see year over year, when we had this conversation last February versus where we are this morning, you see most notably, right, the fixed income returns have gone up fairly dramatically. And that is a byproduct, of course, of just what's going on with interest rates themselves. So that is kind of the backdrop on asset allocation. What does it mean for us in the program? So what we've done for the pension portfolios, you see here, this may be familiar to the committee. We use this format, you'll remember last year, and we've highlighted for you, you see there in the row, the blue row, the existing allocation structures for the pension plans. And we modeled that outcome, and then we just let the system kind of generate an alternative model using those same asset classes. And then we kind of plus and minus just to give you a bracket or a range around more and less aggressive mixes here. And really no surprise here, the portfolio, push comes to shove, remains optimal from a statistical standpoint, right? Essentially plotting on the efficient frontier and, a validation, I suppose, to the committee that the structure that you have in place today is optimal from a risk return perspective. Look at, though, on the forecasted returns, 8% is the expected return on a go forward basis over the 20-year forecast period, right? So that kind of nicely outpaces what your return assumption is currently for the pension plans. But again, we're just not of the mindset that we make wholesale changes right now in the cycle, given some of the lingering uncertainty. So our inclination and recommendation to the committee would just to stay the course on the high level mix we have currently, again, as highlighted in the target weights, and let markets settle in here a little bit. The other question it begs, and someone may ask, I'm sure Lisa would if she was online, is how our numbers compare to the Milliman numbers. So we have had a number of conversations with the folks at Milliman. Their return assumptions are higher as well year over year, not to the same extent that we have. So when they model your portfolio, I don't have the exact number in front of me, but it'll model a touch lower than the 8% return we have here. And we've had that, modest deviation from them in the past. I think more importantly for the committee, in talking to Becky and the team at Milliman on your behalf, they're of the same mindset that we are, that probably not a time in the cycle right now to make wholesale changes to allocations. There certainly won't be any pressure this year to reduce assumptions further. I know Becky's already told me that, but, some folks starting to chatter about, hey, can we increase the return assumption given what you're seeing for capital market forecasts? And again, our inclination would be to, let this uncertainty settle in a little bit before we make any wholesale changes. So kind of around the horn there, that's our kind of big picture remodeled portfolio. You're efficiently allocated from a statistical standpoint. You're diversified is, a mantra that we always talk about. And I think in pretty good working order, all things considered, on the allocation front. But let me pause there for a minute. I know that's a lot of data and stuff to throw at you, and see if that resonates with the committee or if there's things we need to chat about a little bit more.
Derek, when you're ready, I have a question.
Sure, go ahead, Lisa. Why, I'm sorry, I didn't see you. I didn't know you were on. Good morning.
Good morning. Derek, is it okay?
Of course, yeah.
First of all, thank you for that. And that was very helpful. I mean, the other option we can think, I agree with you to do nothing right now. That makes a lot of sense and watch things settle. But the other option, if these rates are higher, is we can reduce our risk and put it in less risky investments would be the other option, and keep it at the same rate. So I just asked you to think about that as well as an option.
Yeah, so Lisa, that's absolutely right. I mentioned earlier, That's been a question we've gotten quite frequently, right? Here's our kind of, so this statistical information is great. It's necessary, right? It's important, but it should come alongside the perspective of just what's going on in the markets in real time, right? And we had that big downdraft last year in equity markets. Historically, that has not been a particularly opportune time to trim equities further, right? Because you get those snapbacks and then you say, what did we do it there for? I mean, you do that when something's gone haywire, right, in the good direction. And we've seen that in the fourth quarter, as we'll see in just a second. And we've seen it in January with global equities up 8%. So absolutely accept your input there and understand it. And it's a reasonable request. Again, our inclination is, it was such a unique year last year with the broad downdrafts with both equities and fixed income, a little bit more pronounced with equities, that there is that, right, kind of maybe an innate desire to make things more conservative and hunker down. I'm not sure pragmatically if hunkering down on the heels of last year, right, is a great idea.
No, agreed.
Yeah.
But if the long-term investment rates are significantly higher than we were projecting with this allocation at some point.
Absolutely. Oh, absolutely. Yeah. If things continue to stabilize and we see the Fed, right, kind of make its way through the campaign and we get this new base and markets start to function more consistently, for sure, we'd be back to you with some thoughts maybe around reconfiguring the allocations like you suggested. So that's certainly something we're mindful of and monitoring for the committee. But a good point.
Thank you.
Questions on assumptions input to get us under the hood a little bit. Any house view on, how, you had mentioned earlier, maybe a couple, Fed hikes, given the jobs report, and see how that might, maybe push out another 25 or so. But then, in light of the conversation about, not rebalancing, I'll call it, or, move maybe slightly towards fixed, is there the assumption potentially that there could be a retreat by the Fed sometime this year in your models?
Yeah, so I think absolutely, Derek. So I think, right, what we what baked into the 2023 numbers, right, are we had lots of discussion around the pace and the ultimate, the terminal rate for the Fed activity, and that's certainly baked into the expectations here that we've got. And you're right, right, we'll see where things ultimately come out. The markets are acting today like the Fed's austerity is running out of steam and that they're actually going to be able to navigate, right, this so-called soft landing. And you've seen that with capital market returns the last 4 months or so, which have been very strong. But to answer your question more explicitly, yes, when you look at these return assumptions that we've got, use U.S. bonds as the kind of our anchor proxy, right? 5%. That does contemplate kind of where we stood at year end with the Fed activity to date and expectations where it may go over the next year or so. And then even right on the back end of that, 2024 and the like, a notion that maybe they actually begin to offer some rate relief if things kind of go according to plan. So that's all kind of baked into the number that we develop here, and trying to anticipate that or acknowledge that those outcomes in these return assumptions. So it's a workable number for us to have conversations on the allocation of the programs.
Thank you for that. Yeah,
those are great questions. And again, pause. We're in good working order from an allocation perspective, right? The models or the allocations, I should say, in place today, obviously align with and are within range and no issues from an allocation perspective. So I just wanted to mention that quickly. It's just warehoused information that it's not a focus of this quarter, but I think we're in good working order there. So that brings us to just where we stand from a return standpoint. So obviously a challenging year, right? There's no escaping that, unfortunately. But you do see a measure of recovery, certainly on an absolute sense for the plans in the fourth quarter, up about in line with the broad markets. That's town plan and you'll remember, bear with me here, I'll jump around a little bit, Board of Ed plan, everything within about a tenth or two based on cash flows, but the portfolios all had nice stabilizing return quarters, up, 6.5% or thereabouts, which obviously is encouraging. Don't have the numbers for January, but as I mentioned, equities were up, north of 8%, and bonds actually up 3% in the month of January alone too. So the portfolios are a touch higher here as we sit here this morning, and we continue to have decent returns, and we'll see how things flesh out here. From an allocation perspective, right, I think by and large, we're in good working order. As you remember, right, we do warehouse a little liquidity just so that Amy can make pension payments and principal can make pension payments, but otherwise running relatively close to our standing allocations. And right, these numbers bounce around a little bit day to day. In fact, we're probably even a bit tighter as we sit here this morning to these target weights, given what's gone on in January. So I don't have a recommendation per se on the allocations. We do have, as a reminder, just for the minutes for Melissa, BlackRock Strategic Income Opportunities was elevated to discuss. You may remember from the fall, one of the lead portfolio managers on that strategy is retiring at the end of March. And that's something our research team spending some time with the BlackRock complex on. They always have done a good job backfilling and planning for those transitions. And we think that's the case again this go round. But it is a noteworthy change, and it does require us to do a bit more monitoring. So we do have that on discuss, no action needed from the committee, and something we'll keep you updated on. And otherwise we're generally in good working order here across the roster. Let's just do this. We'll kind of complete the loop here, if you don't mind. Board of Ed, similarly, right, relatively close to target weights, and I think in good working order. And then finally, for police, kind of that same directionally, those same types of relationships, actual to strategic, target weights rather, and I think in good working order. So, fingers crossed here that what we've seen in the last 4 months will persist a little bit, and we can, have a better year than we did have. I think what's interesting, maybe just one last data point on the portfolios. I think we're all accustomed to this, right? And we get these corrections and frictions in markets as the economic regime changes, and they're inevitable. But I think the one fortunate thing we do have in the bank, right, here's just the aggregated plan outcomes. Look at the calendar year numbers. So 2020 and 2021, you see there, nice double-digit absolute returns and relative returns as well. And that's right, kind of been the pattern where you get a collection of very constructive outcomes, and then you have a kind of a regurgitation and some friction, and then markets settle down, and then hopefully we're stabilized and off to the races again. So certainly we're mindful of that pattern, but have an expectation that right, we know markets go up more than they do not. So something to be mindful of. Anything else?
So Chris, we'll have those 2022 numbers at the next meeting then, the final 2022s?
Oh, no, I'm sorry, Derek. They're right there. So you see the 1 year number up at the top of the screen, the minus 14.9?
Oh, yeah.
Oh, yeah. I'm sorry. Okay. It's weird. I should show you back here, on the upper left-hand corner too, the 1 year numbers, the 12 months ending in December.
Gotcha. Thank you. Sorry about that.
No, that's okay. All right, again, just stop me here if something arises. Quickly on the OPEB trust, just to catch the committee up. Remember, all indexed here, right? There's a little bit of volatility quarter to quarter based on balances and based on some of the metrics of how returns are generated in the ETFs, but the portfolio kind of running over the long haul, right, in line with the broad markets, which obviously is the intention given the construct. So up about a little over 7% in the fourth quarter for the OPEB assets. So a nice gain, right? About $1.3 million booked as a gain in the fourth quarter alone, which is a nice outcome. All right, ETF are all indexed across the entirety of the lineup. And pretty darn close, as you see there, to target weights and kind of the diversified expression that we've had for some time. I think I've got it on my short list, and we'll take input, obviously, from the committee, but our intention, again, we've scratched at this idea a little bit in the past, is maybe to begin, now that we're at, call it $20 million of invested assets, to at least, if there's an appetite from the committee, right, maybe begin to fold in some active management here where we think there's, better incremental return opportunity. That would be in, just to preview, if we want to go down this path, that would be in areas like fixed income, maybe small cap in the US. I don't see any reason to leave indexing in the large cap arena. Maybe a measure of active in the international markets as well. And one of the things we could look at perhaps is kind of a mixing and matching, where we just on the margin introduce a little bit in the way of active management, but keep tethered as well to a meaningful amount of indexing just to control costs. So that's something we can flesh out in subsequent meetings, but I know it is something we've talked a little bit about, and happy to take input from the committee. You're nicely diversified and very cost effectively invested, but over time, there might be an opportunity to do some things here as the asset pools grow.
Are you looking for that input now?
Yeah, absolutely. So I'll defer to the chair, but sure, if you've got thoughts on it, happy to take those.
So I don't disagree on international and the fixed assets. That makes sense given how fluid that is and how uncertain sort of international is. I think it's worth looking at.
Yeah,
how have the active managers done, say, over the last 3 years in those two asset classes relative to the benchmark?
Yeah, it's a great question, Tom, right? And it's a little bit mixing and matching here. So we'll use some of the managers, and it's, as on the pension plan. So let's look at here, the fixed income managers, right, in the square in the middle of the page here. And to your point, right, that certainly the 1 year number was stressed for MetWest and Western, right? In that rotation and the violent uptick in rates, they were challenged a little bit to navigate that. Ultimately did, and you see them stabilizing more recently. They've been value adders, right, over the longer haul. Look out to the far right there, right? When you expand the lens a little bit, right? They've done a better job. I'm sorry.
That's over 10 years where they start adding value, if I'm reading this right.
Well, yeah, but the other thing I'd be careful of, and let me just, and I don't think, Tom, we've got the calendars in this report. So the way to think about this, right, is as anything, right, there are cycles and kind of return cycles associated with all these strategies, and sometimes the managers struggle, as we know, and more often than not they don't. So the short answer to your question and your observation, I think, and intuition is probably where this is going. The last couple of years have been difficult for the active managers. BlackRock actually has done a better job, right? But they're intentionally in the program to offer that more defensive mentality. But all three of the managers, with the benefit of time, have been additive to the experience that the portfolios have generated. And international equity, right? Generally the same story, although a little bit of a mixed bag, right? I would focus on the Hartford strategy. And again, right? So 1 year, a bit behind the benchmark, a 3 year ahead of the benchmark, 5 year ahead of the benchmark, 10 year ahead of the benchmark. Templeton's a little bit of a different animal in the small cap arena. That's another manager I should have mentioned, right? That we're doing some work on and likely are back to the committee on in short order. But it's a mixing and matching game, right? I mean, unfortunately, you just don't see a manager that outperforms all the time. We'd love to find those managers. I'm just not certain they exist. We've got to do the work to hopefully get you comfortable with the idea that with the benefit of time and over the entirety of a return cycle, right, that the manager can be up to task and generating some extra return for the higher fees that you're paying. And a lot of the managers in the program have that complexion, right? It's just it's not on every time point. So I don't know, Tom, if that helps or hurts, but
Yeah, I'm just not totally sold on active management.
Gotcha. Yeah, I can listen. As we've talked in the past, right? That's somewhat of a philosophical thing for the committee, and I think moreover, right? It's just bear with me here, right? I think it is this committee, right? We've got meaningful amounts of indexing in the program, right? We've got Vanguard Institutional Index for over 20% of the portfolios. No need to change that from our estimation, right? That's an area of the market we just don't think you can make hay with active management. And you'll remember we had swapped out the EM manager for a Vanguard index as well. So it's a balancing act, right? I think there's a place for both indexing and active in thoughtful investment programs. And I think, that's continue to be the mantra that we'll operate under and to different direction. But good question. So Mr. Chairman, I think that's all I had in the way of updates on pension and OPEB. I do know Tyler needs a bit of time for the DC review. Happy to take more questions, but I don't want to overstay my welcome on the agenda.
No, that was a great overview as usual, Chris. Thank you for that, and thanks for the participation from the group. And yeah, we can flip it over to Tyler and to continue.
Great. Tyler, do you want to take over the screen or do you want me to do it?
I think it just gave you permission, so I'll let you continue to drive if that works.
Okay.
We can just start at the governance calendar on the DC side there. All right. Well, hello, everyone. This quarter for the defined contribution space with respect to the governance aspect is a practice and policy focused quarter. So it's a good update. Bye, Lisa. Good opportunity to go through regulatory and legislative updates. Talk briefly about best practices, and we did include the investment policy statement for brief review. As luck would have it, end of the year in December. If you go to the next page, Chris, we had Capitol Hill sign it. Back one. There we go. Right there. We had Secure Act 2.0 pass mid-December last year, which includes about 92 provisions that do impact the defined contribution space. And people can say what they want about the federal government, but they're really good at acronyms. Secure Act, Earn, Enhancing American Retirement Now. I mean, all these are pretty robust, but all of those were consolidated and do go into effect 2023. And I'll briefly touch on what impacts the plan now, touch on what are optional provisions for down the road, and then we'll get into the performance of the investment options. But as far as mandatory provisions, starting today, there's the minimum required distribution. So if someone's no longer employed and has a retirement plan or a retirement account, the federal government wants you to start taking money out of the accounts. And so it used to be 70.5. It got changed to 72 with the original Secure Act, and it's now 73 on its way to 75 by 2033. So a delay now on when people are forced to take their money out and, of course, forced to pay taxes on it. There was also a decrease in the penalties for people taking those monies out as well. Couple impacts to catch-up contributions. So just a reminder how catch-up works. People for 2023 can contribute $22,500. If you're older than 50, you can contribute an additional $7,500. And so that's the idea that 7,500 is what's called a catch-up, as in you're catching up in the later years of your career. One of the mandatory provisions is that anybody who makes the equivalent of a FICA wage that exceeds $145,000 next year, that catch-up contribution will have to be Roth. This is across the 457 plans, 401k plans, 403b plans. This is a mandatory provision. It seems simple on paper. It's just another thing that people will need to track. Because prior, within the defined contribution space, you didn't have to track prior year wages for current year contributions. So just another administrative challenge potentially, but again, not effective until 2024. There's also, starting in 2025, an increase in catch-up contributions. You're able to, for 4 years, between 60 and 63, you can contribute 150% of the current year's catch-up contribution limit. They index it at 10,000, but actually that's less than what it would be under the current catch-up rule. So for instance, if catch-up by 2025 is at 8,000, those ages, you can contribute up to 12,000. So increased catch-up, Roth mandatory for certain folks that make a certain amount of money. The long-term part-time doesn't apply. What would apply is governmental 457 plans are restricted to participants are restricted to making deferral amount changes to the first day of the month. They can't change on an ongoing basis. That's been thrown out, so there's a little bit more flexibility there. On the next page is some optional provisions to think about. Again, one of which is potential for now, but no one can figure this out yet. I'll explain what that means in a second, and then some for the next couple of years or so. There's a student loan matching contribution provision, which would allow you as an employer to match in the retirement plan based on what someone's making in student loan payments. The idea behind that is if I'm an employee and I can't contribute to the matching structure because I'm under sort of student loan debt, you could decide, this is completely optional, to say, yeah, you know what, we're going to continue to match you in the retirement plan. We understand that the student loan is a burden, and so we'll continue to match you on it. So that's also a self-certification rule, meaning I would just have to self-certify that I'm making a student loan contribution. The employer doesn't have to track that amount. A couple of the more interesting provisions. One is and this is effective now, but to be candid, none of the record keepers, and I had long conversations yesterday with Fidelity, and no one's ready for administering this, but it would allow for you as an employer to let employees take their employer contribution and each match or core contribution as a Roth contribution. Give some flexibility. Again, it's an optional provision. You don't have to do this, but it would give some individuals some flexibility on how they want to take their taxes on all contributions. Of course, you have to pay taxes on that employer contribution. So payroll setup has to be done around taking the taxes, the applicable taxes for an employer contribution out. And of course, someone has to be fully vested in those contributions as well. The last two provisions, and I say the last two, there's 92 other provisions. These are kind of the ones that are getting more quote unquote press, but there's some provisions around, new retirement plans have to be auto enrollment and auto escalation, et cetera. But a couple of the more provisions that are getting bigger press. One is the emergency savings account, or the PLESA, which is what they're calling a emergency savings account sidecar to an employer plan. This would allow you as an employer to say auto enroll individuals into a emergency savings account that would be essentially a cash account. I know it says it'd be in a Roth contribution, but technically these would be required to be money market or stable value vehicles. But you could auto enroll people into these accounts to essentially build out a $2,500 emergency savings account. I think this the government heard a lot about the lack of emergency savings that a lot of employees in this country have, and they wanted to build something around that. Again, people would be able to take their money out at any time, and would be subject to taxes. There's also a provision that would allow or give flexibility for individuals to take $1,000 out of their retirement account per year with no tax or penalty. Unlike a loan or say a hardship, this would give a little bit more flexibility for people to get access to emergency expenses. There's nothing that needs to be done right now. Your record keeper tracks the minimum required or the RMD, minimum required distribution. So there's nothing that you need to take action on. There are obviously some things to think about over the next year, and I think the industry itself is still waiting on some guidance for how to administer some of these provisions as well. I'll pause there. I know I went through a few. Any questions around the Secure Act before I move on? Chris, if you want to go to the next page there. The only thing I'll address here, the DOL also provided a ruling back in November of last year. There was a lot of criticism under the previous, the Trump administration around socially responsible investments and the fiduciary's ability to select those investment options. The Biden administration DOL actually threw that rule out, which just gives you this committee a little bit more flexibility on selecting those types of investment options. When I say ESG, environmental, social, or governance. So the prior DOL was really critical on our ability to say, the town would like to offer a low carbon footprint investment option. That would technically, under the previous DOL, be in breach of their ruling. Now, we can't ignore performance, but we can have a conversation around those types of investment options and potentially add them into the defined contribution plan. Really quickly on the next page, Chris, just wanted to remind everyone there was a Supreme Court ruling on technically it was an ERISA plan. You're obviously a non-ERISA governmental plan, but the defined contribution space is getting targeted with litigation. More recently, over the last 5 to 7 years, the private educational institutions have been sued, claiming the fiduciaries didn't proactively ask their record keepers, Fidelity and TIAA, to lower their record keeping costs, and at times they didn't get access to the lowest share classes available. The appeals court threw the Northwestern University case out because the plan itself had investment options that were higher in cost and lower in cost, some of which they didn't actually lower the share classes when they could have. The courts ruled in favor of the fiduciary, saying, well, because it's participant directed and the participants can select both high and low cost funds, that the fiduciaries didn't have a breach in their responsibility. Supreme Court threw that out and said, no, fiduciaries are responsible for all the investments in the retirement plan, and just because there's participant direction, that doesn't avoid that responsibility. It got sent back to the appeals court, and the appeals court then ruled in favor again of Northwestern University, stating that there was a meaningful benchmark when they were reviewing the fees, and the lowest cost funds are not necessarily the ones that are most prudent. So yeah, I think this just reiterates the process that we put in place. Next quarter, we'll be spending a lot of time on fees and benchmarking those fees for reasonableness. And again, we have in place the ability to evaluate the assets in each of the investment options, and when your plan meets certain breakpoints to lower those share classes when they're available. I'll pause there. Any questions around our governance calendar? If you want to move, Chris, to the, I won't go through all of these. Just to note, this is some best practices around a fiduciary committee for a defined contribution plan. A lot of this we have in place for you. Again, reviewing last quarter, we spent some time on cybersecurity protocols for your record keeper. We evaluate and have an internal due diligence on your plan's record keepers as well. Fees, benchmarking fees for reasonableness. We actually reached out to the record keepers and tried to understand a little bit more about how they locate lost participants. When I mean lost participants, it's individuals that no longer work at the town, but have an account, but maybe a bad address. And so because there's so many required disclosures, there needs to be a process in place for locating those individuals, which your record keeper has in place. So if you want to go to the 2 more pages, Chris, I'll touch on the balances here so you can see clearly down from that high at the early part of the year to about 13.7, up from the third quarter. So obviously reiterating what Chris said, div challenge 2022. Still a big portion in the plus fund, the Vantage Trust Plus Fund, which is the protection of principal fund. The next highest is the S&P 500, that Fidelity 500 index. And then, of course, it's the T. Rowe Price target date funds, which reflects the default investment option. So that, I think, given there was such a big portion in the plus fund, has softened the decrease over the last year, but still obviously a challenge market for investors. If you go to the next page, the Board of Ed plan, similar allocation, a little bit more in the plus fund. You go to the next slide is the 401a. So 401a being the newer plan and bulk of the assets there in the target date funds. We do include on page 55, the next page there, some information around the T. Rowe Price retirement funds, still run by Wyatt Lee. You can see they did make a slight change over the last, call it 24 months or so, of an increase in equity exposure in their glide paths. I will show you some slight underperformance. T. Rowe Price has struggled a little bit in their growth investing, and so that's weighed a little bit on the near term. But if you go to the next page, Chris, you'll see longer term over the 3, 5, and 10 year, the T. Rowe Price funds continue to be the top decile performing fund per vintage. Some noise on the 1 year given the higher equity position. Some of their growth mandates didn't do as well, but longer term still outperforming the index and outperforming peers. If you go to the next page, it continues on the various vintages, and that continues to hold true for the longer term performance. But obviously, the 1 year was a challenge for the T. Rowe Price target date funds. If you go to the next page, we do have all the funds on maintain. I know Chris touched on Western Asset. I won't belabor the point there, but longer term still outperforming. If you go to the next page, I will touch on one fund. I talked about T. Rowe Price growth struggle, blue chip growth, institutional growth, and of course growth stock. One of your active growth managers has clearly struggled longer term. All of which has been coming from the last year, 2022. Joe Fath is still the head portfolio manager, so there hasn't been any change to their team. They do hold a lot of private placement, so a couple of their investments, Rivian being one, was a challenge, and they were also overweight some of the larger sort of FANG stocks that underperformed, the Amazon, the Meta, the Google, instead of say Apple, which outperformed relatively those other tech names. So that weighed a lot on the 1 year and is obviously dripping into the 3, 5, and 10 year. I will say there was only 1 year out of 11 they were bottom quartile, and that was last year. So we're giving them a little bit more patience there. They've actually recovered quite nicely in the first part of 2023, outperforming the index by about 500 basis points. So we'll continue to evaluate that fund, but we do have it on maintained. Don't recommend any changes right now. So I will pause there to see if there's any questions about particular investment option or Secure Act or governance.
Tyler, what's your patience level just in terms of T. Rowe, Growth One? Like how much? I know there is some. Well, I don't know if it's volatility in the tech, but you know, how much longer do you typically maintain, and what's the alternative?
So it's more an art than a science. And again, once a fund goes on watch, we won't keep it any longer than 4 quarters.
Okay.
We do have blue chip T. Rowe Price blue chip growth on watch, but there was some portfolio management changes there. Again, the T. Rowe Price growth space is a little bit more weighted on the tech side, and in the growth index, 10 stocks make up 50% of that whole weight. So if you're over or underweight the wrong names, it can significantly weigh on performance. Given that, I mean, and if you go to the next next page, from an annualized standpoint, you could that top line there, you can see they've been fairly consistent, and this is sort of 11 years. A lot of that's coming off of an environment where growth is going to struggle, right? High interest rate environment where you know, you're reducing the present value of future cash flow, so that's going to weigh on it. But you know, in an environment where we see the inflation moving in the other direction, you know, we'd expect that to outperform, and if it doesn't, obviously that's where we make a decision to either place that on watch or move forward with another status.
Yeah, that makes sense. Thank you.
I did include on the end of the, and I'm sorry, it's probably I don't see page numbers, Chris, I apologize, but if you keep going there, yeah, right there. I did include the last iteration of our investment policy statement for review, but we don't recommend any changes to this document. So that's all I had for today. We also include a white paper on Secure Act if you want to read up more about that. But you know, there's feel free to reach out to me. I have plenty of collateral around the Secure Act if you want to read up more about the 92 other provisions that are in that.
Great. Thanks, Tyler. Thanks, Chris. Thanks, Bert and Todd, for sticking around. And, you know, as always, appreciate the insights and commentary, and we'll look forward to seeing you next time. I think just in terms of potential action items, and maybe we can discuss a little bit before the next meeting, we'll see. But in terms of maybe potential some active investment, I know it's come up before, and it seems like we end up, you know, trying to or figuring it out at the meeting. You know, I'll talk, maybe even get a minute about it at our next Board of Finance meeting as well, just to let the board know that will potentially talk about some active management, notwithstanding, you know, some of the comments either for or against today. Maybe we could allocate a little time next time to have a more robust discussion. But again, as always appreciate you coming on, and we'll put that we'll put the annual party in our calendars, and look forward to seeing you guys next time. So with that, I'll take a motion to adjourn.
I'll move that. I'll
Second.
second it.
Great. Thank you all. Have a great rest of your week.